In this video, I'm going to talk about technical analysis and cover the first section on trends and corrections. So let's jump into it and see what technical analysis is. All right, so technical analysis, the book defines it as attempts to exploit recurring and predictable patterns in stock prices as well as volume information to generate superior returns. So when you hear this definition, what you should think of is you should think of the weak form of the efficient market hypothesis. If we remember that, the weak form said what? The weak form said any information in prices, past prices, or volume information cannot be used to help you generate a superior return. So technical analysis here is running exactly counter to that. And these are methods that if you believe in these methods and use these methods, you are disagreeing, you are violating that weak form of the efficient market hypothesis. So these are methods that basically challenge the weak form, and these are ones that say, hey, maybe there is information in past price and volume information, and I'm going to use that to try to help my trading. Okay, so that's a very good way to frame technical analysis as a challenge, a direct challenge to the weak form of the efficient market hypothesis. All right, a couple of things before we jump into it. Technical analysis is a very broad subject, okay? And at one point I'll try to show you just how many technical indicators there are. It's huge. You could spend a lifetime studying technical analysis. We're gonna hit only some of the best known indicators here. If you're interested in the subject and you say, hey, this resonates with me, I like the ideas behind technical analysis, then I highly recommend further study on your own in this area. Okay, so with that said, we're going to split our technical indicators and our technical analysis into two different categories. The first ones we're going to call trends and corrections, and then the second one, sentiment indicators. So here I'm going to cover trends and corrections. All right, so trends and corrections. What do we mean by that? Some technical indicators are oriented toward determining when a stock is trending. What is a trend? Well, you see a stock is going up. Is it going to continue going up, right? Or if a stock is going down or trending down, is it going to continue to trend down? Or whether it is in correction. That means what? That means reversing, right? So a stock that's going up, if it doesn't continue to go up and if it pulls back from its high, we would say that's a correction. It's sort of like the stock was too high. Maybe it was too high up here. And so it corrected itself by going lower. So if you're familiar with markets, and if you jump into markets more, some people actually assign a value to what they will call the market in correction. So they will say a market has to drop 10%, be down 10% from its high, and they will say the market is then in correction. Okay, so that's a term you might hear. And they're assigning a specific value to that. And they would also say 20%, if it drops 20%, they would say that's a bear market, okay? But without assigning a specific number to it, if somebody says the market is in correction or the stock is correcting, what do they mean? They generally mean it was going up and maybe that was too high and now it's pulled back. It's going down a little bit. And that's what they mean by a correction. So these are oriented, trying to tell you whether a market is trending and going to continue to go up or whether it might pull back, okay? All right, we're going to cover a couple of these. The first ones that I'm going to talk about are moving averages, okay, and these are visual ones that you can see on a chart, and the other one is so-called point and figure charts. So I'm going to show you these. First I'll show you the definitions, and then I'll actually jump to some websites and show you where you can find these if you're interested in using them. All right, let's jump into the very first topic here, moving averages. So moving averages are very, very common technical indicators. What is a moving average? It's just like it says. So it is an average. So in particular, we're going to see that there are different number of days moving averages. For example, common ones are like a 200-day moving average or a 50-day moving average. In general, you can do it for any number of days. So here I'm just generically calling it n number of days. So the n-day moving average, what is that? It's simply the average of the last n days' prices, okay? As I mentioned, common moving averages are to use 200 days and just average those prices in the 50-day moving average. And how do people use these? Again, I'll show you some plots, but a common signal that a trend in the price of a stock has ended is perhaps a crossing of the 200-day moving average. What crosses this average? Either the stock price itself or by another moving average, perhaps the 50-day moving average. I'll show you some examples later of that. All right, and many websites allow you to plot various moving averages, so very, very common. How are these actually calculated? Okay, so let's walk through a calculation here. So what do I have in this chart? So every day, time is ticking by, and let's assume this is the price at the end of the day, like the close price. So it closes at 10, and it moves up to 11, and then 12, and then back down to 11. So you've got the price at the end of every day. Now to calculate a moving average, what do? Every day, compute the average of the last 5 days' prices, okay? So for example, I need at least 5 days' prices. I'm sitting here, I grab the last 5 days' prices, and what do? I just average those. So how do I average? I add up, divide by 5, and that would be the 5-day moving average for that day, okay? And then I would do the same thing the next day. I'm at day 6. What do? I grab the last 5 days' prices and I average them, and that's my 5-day moving average. And this just continues forward in time, right? So that's how I would calculate this. Okay, so what does this look like if you plot a moving average? Okay, so here's a plot. This is Intel Corporation, and it's plotting in the dark line here is the 50-day moving average. And what do we note about that? A couple of things to note about moving averages, why people think they're helpful. Number one, moving averages smooth out the prices. So in the blue here, right, we've got the prices, and if you watch a stock price day to day, it goes up and down quite a bit. Okay, it's very jittery. An average does what? Averages smooth things. So the 50-day moving average, what does that do here? That smooths the price. We can see that very clearly that the price is being smoothed. And because of that, it's easier to identify sort of the trend, right? Whether it's moving down and then it's trending up. So that's one thing to note. The next thing to note is that the moving average is always lagging behind the price. Why is that? Because it uses the last 50 days prices, okay? So it's sort of backward looking, you can think of it as looking backwards at the last 50 days. So we can see that it's sort of always behind. Intel has already started and move up, and the moving average is still going down. It takes a while for it to turn around and start going up with the price, okay? So those are two things to note. How are these used? So a very common signal is, I see here the moving average was headed down, 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 and Intel was going down, and then at some point it begins to turn, and right here at A, it crossed the moving average on the way up. That is perhaps a sign that the downtrend is over and now an uptrend is starting. That might be a buy point, okay? So people will watch for those crossings, and they will use them to signal whether maybe a new trend is starting, right? The old trend is ending, okay? And they're showing you here, you might keep it going up, and then when it crosses here on the downside, you might sell. They're showing you here another crossing point. So there are different ways to use these moving averages, but in particular, people tend to place a lot of importance on the crossing of a moving average, either by the price, in this case it's the price, or some of the time they will look at another moving average, right? Like maybe the 20-day versus the 50-day or things like that, okay? So very common way to use it. All right, I want to show you these on a website. So let me jump over here to, this is Yahoo Finance. And I pulled up, for example, the S&P 500. So I actually pulled up the Exchange Traded Fund SPY that tracks the S&P 500. And I just did a plot here. And I went to indicators. And as I go under indicators here, commonly used indicators, and their number one is the moving average. That's why, it's in the book. That's why they're teaching you that. That's sort of the number one indicator that you're going to see. And I plotted here the 50-day moving average and the 200-day moving average right there. And what can you see? So the 200-day, it tends to move more slowly. Why? Because it's averaging 200 days. Okay, it's not as responsive. 50-day is more responsive. That's in red here. And what can you see here? Over the time period that I'm looking, which is about a year, during this time period, what did I see? So if I look at the price, right, the price is going up and down a lot. The price, that's sort of the mountain plot there of the price. that's jittering up and down. Over that time period, what did you have? The 200-day moving average was just very steadily going up, right? So you'd say, look, it looks like longer term, the S&P 500 is in an uptrend, okay? So it might be good to hold it, and you want to catch that trend. You look at the 50-day as well. So the 50-day seemed to be pretty consistently continuing on up, right? So at that time, it was in an uptrend. Then what happened here at the very end, what do we see? The 50-day has started to go down. That's maybe an indication that perhaps the trend is ending. Okay, watch out. The 200 is still going up. Okay, we've had a pullback here or a correction in the price. That's the terminology they might use. And it's down. So looking at these moving averages, it's like, okay, now it's not so clear that it's in an uptrend. The 50-day has moved down. The 200 is still moving up, but the price has actually crossed the 200 on the way down. Maybe that's an indication that I should get out of the market. Maybe that's an indication that I should lower my position. In particular, if this 50-day moving average crosses that 200 on the way down, that would be even more significant confirmation that sort of the uptrend in the S&P 500 is over, and that you should watch out, maybe, get out of the market or pull your position back. That is the way people would use these moving averages. Now, the 200-day and the 50-day are pretty long-term averages. Lots of people who trade shorter term are going to use like maybe the 50-day and a 20-day, or maybe a 20-day and a 10-day, and that would be a lot more responsive to the price. Okay, so that's one thing I wanted to show you there, just the way people would use it. The other is I just wanted to take a moment, and I'm going to click on indicators, and I wanted to show you how many technical indicators there are. Remember, technical indicators are basically taking past price and volume information and doing something with it. In this case, what are we doing? We're just averaging it for a moving average, but you can do many different calculations with it to try to help you in some way with your trading. Okay, and so what I'm going to do here is I'm just going to begin to scroll down, and they have all indicators. This is on Yahoo Finance. I just want you to see how many there are. Okay, so I'm scrolling, and there are, as you can see, just so many different indicators. So the only reason I'm showing you this is just to say technical analysis. There are many, many different methods. It's a huge subject. If you're interested in this, right, I recommend doing some further study on your own. What we see in this class and what you read in the book is really just skimming the surface. Okay, so I just wanted to show you that. And any of these indicators, right, you're going to have to dig in and do your own research. And it takes a while to do that. But people that like the ideas behind technical analysis, there is really a lot out there. Okay, so that was the point in showing you that. All right, so that's a moving average. Let's keep on going to the next kind of chart. Okay, this is called a point and figure chart. And these are kind of interesting charts. Okay, so they trace significant upward and downward movements in the price without regard to timing. Again, I'm going to show you these and show you where to find these on the web. They almost look like a giant game of tic-tac-toe. Okay, there's a bunch of X's, and when you see X's, it meant the price was going up. O's mean the price is going down. Again, I'm going to show you it in detail in a second. And the idea is you try to generate sell and buy signals when a stock penetrates previous highs and lows. That's one of the main things these are used for, is try to identify key sort of highs and lows in the stock. And there's terminology that goes along with it, things like congestion areas, where you see the stock is just going up and down but not really moving anywhere. Okay, so let me dive in to show you what one of these looks like and how they're created. Okay, so once again, what do I have? I have dates ticking by, every day in the market, and I have prices, and the price here starts at 40, and it starts moving along, and we see it goes up to 42 and then 44. Okay, so what does a point and figure chart? The point and figure chart is over here, and like I said, it almost looks like a massive tic-tac-toe game. But here's what it's representing. Okay, so when you start, you pick a price increment. In this case, it's $2, right? 40 to 42, 42 to 44. So I select a price increment. And then if the price moves up by that much, I place an X. So for example, right here, it started at 40, it hit 42. That's why they put the star there on the 42. So that means I place an X here. It cleared 42. Does it keep going up? Boom, it does. It hits 44. I place an X there. Does it ever hit 46? No, I'm looking. No, it never goes up another $2. However, it turns around and begins to go back down. It drops to what? It dropped under 42. And now when it starts to go down, I create a new column here, and I create a column of O's, and the O's indicate that it's going down. So it hits 42. Does it ever hit 40? Yes, it hit 40 right there. I'm going to put an O at 40. Does it hit 38? Yes. Does it drop below 36? Yes. Boom, it keeps going down. Does it ever get to 34? No. Then it turns around, starts going up again, and because it starts going up, I start putting X's. So X's indicate it went up, O's indicate it went down. Okay? What it doesn't show you when you just look at the point and figure diagrams is, look, I knew there were a bunch of O's here, meaning the stock was going down, but I don't know how long it took for the stock to go down, right? So instead, it just focuses you on how high and how low it went, but you don't get an indication of how long it took to actually do that. So if you plot one of these for a stock, it looks something like this, okay? Again, it looks like a whole bunch of X's and O's. And what are some of the key things that people would look at in a point and figure chart? So let me show you. So let's take like this zone right in here. So what do I see in this zone? I see that the stock went up and then down and up and down. It was going back and forth, okay, in that zone. That's sometimes called a congestion zone. It's almost like a traffic jam. Like it wasn't going anywhere. It was bouncing up, down, but overall wasn't really going anywhere, okay? So that's a congestion zone. And what do you look for? People generally look for what they're going to call support. What is support? This is a price, so here it was somewhere around 113. This is a price that for whatever reason the stock doesn't want to drop below. It's almost like somebody, put their hand below the stock and said, you know what, every time you come down to that, I'm going to hold you up. I'm going to support you, okay? The opposite of support is what we call resistance. That was a level here, and that was what, around 121. And that was every time the stock went up there, it was like somebody puts their hand on top and pushes it down. They resist it, okay? So that we would call a resistance level. And by using these point and figure charts, the idea is that maybe it's helpful in identifying support and resistance. Why would it be helpful to know support and resistance? Well, let's first look at support. If I can see that, look, this stock seems to be supported at around 113, then if it comes down around 113, every time in the past when it got near that, what happened? It bounced back up. So that's probably a good price to buy it at, right? So I see that it comes down around there. I would buy in. Maybe I would place a stop loss a little bit below support. If I'm wrong, okay, I'll get stopped out. But otherwise, in the past, what happened? It always bounced back up. Maybe that's a good buy point. Resistance could be a good sell point, right? So resistance, I try to buy down at support. It goes up here. Well, look, every time in the past when it came close to resistance, what happened? It sold off. It dropped back down. So maybe this is a good point. It's coming up here. If that resistance is still there, maybe this is a good sell. I'm going to get out. I'm going to take my profits, and I'm going to wait till it drops towards support again. Okay, so that's one way that it's used. The other is that people will look at this resistance, and they will watch for a piercing of resistance. In this case, it gets pierced to the upside. So if it gets pierced to the upside, what is this? Maybe this is a good time to buy. What's the philosophy there? Well, in the past, for whatever reason, when it came up toward resistance, people thought, or the market thought, this is too expensive. And that's why it sold off and went back down. Now, for whatever reason, I don't know the reason, right? But for whatever reason, when I look at the price action here, this time people didn't sell it off. They don't think it's too expensive, and it continued on up. So it's sort of like, aha, something must have changed with the stock. And I can see that using these point and figure charts. It pierced that resistance. Maybe that's a good buy, and I'm hoping to catch this trend up here. Okay, and that's the idea. And then on the downside, they would look at the same thing. Often resistance, people say, becomes the new support level, right? So over here you can see that it went back in a congestion zone, but that price sort of became the new support level, except when it was pierced again, then that's probably like, okay, there's no more support there. It's time to get out. Maybe I'd sell or even short. Okay, so that's the idea behind these. Now, note there's a lot of interpretation in any of the technical analysis stuff that you do, right? So it's taking this past price information, in this case, it can be past price and volume information, massaging it in some way, plotting it in some way, doing calculations in some way that hopefully is helpful for your trading. That's really the essence of what we call technical analysis. Okay, so in point and figure charts, it's trying to help you identify these key prices, support, resistance, whether a stock is in congestion or not. Let's jump over. I'm going to show you where to find these on the web. These are a little bit harder to find than the other technical indicators. Okay, the other ones like a moving average and stuff like that are very common. This one, where did I go? I went to stockcharts.com, and then you can go to their charts and tools, and you can find point and figure charts, and you can put in a ticker symbol. I put in the whole market right now. Okay. And so what do I see from that? Again, I see all these X's and O's. Let's make this bigger so that we can see it more easily here. What do I see? I see all the X's and O's. The market had been on what? A big, big uptrend here. Okay, very, very big uptrend. And then what do I see? It seems like it's stopped. Okay, there seems to be some resistance here at about 610. Okay, what was I looking at? I was looking at the S&P 500 exchange traded fund. Okay, so the S&P 500 was about a little over 6,000. The exchange traded fund that's tracking it was like a tenth of its value at 600. So here I see, there seems to be some resistance there, right? So maybe I was holding this and it kept on bouncing up toward that, and every time it would sell off, it'd try again, it would sell off, like, you know, maybe it's not going to go higher than that. That might have been a good sell point. Seems like recently it dropped and it broke through. You might have said, look, it looks like there's some support here at about 5,800. That was clearly pierced. It's dropped down. It's begin to bounce up a little bit. So again, key levels might be back at this 575. Let's see if it can clear that. If it can clear that, maybe it'll go back up into this zone. Otherwise, I would watch out when it hits here, see if it is able to clear that or if it's able to pull back. Okay. So again, a lot of interpretation here. I'm just giving you some interpretation, not that I'm an expert on point and figure charts, but this is sort of the way people would use it to identify these key points, and those are ones that you would want to watch very carefully when you are looking at the stock. So it's kind of fun. Maybe pick some of the stocks, maybe some of the stocks you have in your Market Watch game, go put them in on a point and figure chart and see if you can see any of these levels and if you can benefit from that or get any interpretation from it. Okay. Let's keep moving on. So those are point and figure charts, and make sure you're familiar with some of the terminology, resistance, support, congestion, and the basic ideas there. All right, let's move on to a couple more trend and correction indicators. Okay, so here's one that you will come across a lot. It's called market breadth. Breadth sort of meaning, you know, how wide something is. And this tries to capture the extent to which a broad market index movement affects individual stock prices. What is the idea here? The idea is many people just watch an index. Okay, if you watch the Dow Jones Industrial Average, you're seeing only 30 stocks. If you look at the S&P 500, you're looking at the large cap stocks, right? And it's 500 stocks, but remember it's a valuated index. So you're really only picking up probably the top 20, 30 largest stocks. They're the ones that really move the index, okay? So the question here is that does an index really represent the broader market? Again, the total breadth of the market. And how would you know that? So maybe the S&P 500 continues to go up, but it's only because of some of those mega caps, you know, the NVIDIA, the Microsoft, the Apple, the Amazon, that those are moving up, but maybe the rest of the market is actually moving down. And I'm missing that by just looking at a market index. So how can I capture the full breadth of what's going on in the market? That is the whole point of defining market breadth. The most common measure of breadth is the so-called advanced decline spread. Remember, a spread just means one minus the other. And here, advanced means what? The stocks that are advancing are going up, minus the number of stocks that are declining or going down. Okay, so that is, it's the difference between the number of stocks that are advancing and the number that are declining. Very simple measure. How many stocks going up minus how many stocks going down. Okay, that is a typical one that you will see. Some of the time you can find a cumulative advanced decline line. And what is that? Every day they just see how many stocks are going up minus how many stocks are going down. And they add it to itself every day, and they just that becomes cumulative over time. I'll show you a simple example of that. All right. Where do you find this information? Okay, there are a couple of different places that you can find it. But if you want to know how many stocks were advancing and how many stocks were declining, okay, you commonly go and look at what's known as a market diary. Okay, and the market diary, this one that I'm showing in the slides, has it broken down by what? The New York Stock Exchange, how many stocks there were going up, how many going down. The NASDAQ is known for more high tech. How many there were going up, how many there were going down. Those are the big ones that you would look at. But look for the term market diary. Okay, that tends to have this information. Okay, and then what is the market breadth? It's defined as advancing minus declining. So in this case, we've got what, about 2,700, almost 2,800 advancing, and declining we have 270. If you subtract those, you're going to get somewhere around 2,500. That would have been a very positive day. Why? Because so many more stocks were going up than down, right? And that would be confirmed by the NASDAQ on this day. Okay, so again, here's how you calculate it. Let's do a simple calculation here of market breadth. Every day, you're going to look up in that market diary how many stocks were going up minus how many stocks were going down, and that's going to give you the net advances. This is right here is what we call the breadth. Okay, I should have put that name in there. Net advances, that is the breadth for the day. Okay, so in this day it was pretty even, 54 more up than down. The next day I calculated 277 more up than down. The next day was, it looked like more were actually going down. This would have been a stronger negative day. 610 more stocks were going down than up. Okay, so that's the breadth every day. And then some of the time people will calculate cumulative breadth. So what do? They start at some point, okay, 54 was the first day, and then the next day, what do? They add the breadth the next day to that. So add 277, I get that. Subtract 69 from 331, I get that. Subtract 610 from 262. So they would just cumulatively add it up day after day. And if you do that, then you can plot it. It almost looks like an index. So some of the time people will plot that. Okay, but in general, if I just say, what is the market breadth? It's just this advance minus decline each day. Let me show you that this is actually hiding in some of the charts that, not some of the charts, but I'm going to go to FinViz here. And FinViz is a nice one. You know, it's financial visualization. They're telling you a lot of different things. So I watch here, here's the Dow, it's got the big indexes, the NASDAQ, the S&P 500, okay? And again, you can look at those, but then if you say, well, hey, what was happening in the broader market? Are those representative of the broader market? Right down here, what do they have? They're telling us advancing and declining, okay? So it's interesting, I look up here, I look at the Dow, it looks like the Dow, actually the Dow started down below the red line, but it moved up, and at the end of the day actually finished up. But when I look over the broad market, okay, how many stocks were advancing? Only 28%, more than 68% were actually declining. So it turns out for the broader market, for most stocks, it was actually a down day, okay? So that is our notion right here, advance minus decline. In this case, it would have been a negative number, is the market breadth for the day. Okay, there's some other things that you see as well here. So very interesting. Let's look at these. How many stocks hit a new high today versus a new low? We can see a lot more hit new low than new high. So that would be a bearish or a negative sign there. What about this one over here? Above and below SMA 50. What is SMA? Simple moving average. That's the moving average that we talked about before. And you see here that's so common that FinViz is telling us across all the stocks in the market how many are above their 50-day moving average. Those would sort of be in an uptrend. You might think of that as a measure of an uptrend, and how many are below. And then right over here, they've got SMA 200. That's the 200-day moving average. I said those are very common ones, 50-day and 200-day. How many are above? How many are below? And again, we see that the majority of stocks are actually below that. And then they have some other measures here. So I just wanted to show you that we're seeing technical analysis ideas pop up on many financial websites because many people look at them. Even though, just to remind you, the weak form of the efficient market hypothesis says, hey, if markets are weakly efficient, then none of this analysis will help you. So if you use technical analysis, you are assuming that what? You're assuming the weak form does not hold and that this information actually can help you. Okay, so I showed you that. That is market breadth, advances minus declines. Okay, let's do one more in trends and corrections. And remember, I showed you there are so many different indicators out there. You could spend a lifetime studying them. Again, we're just going to hit a couple here that the book has chosen to focus on. So last one here is one called relative strength. Okay, and watch out. If there is anybody who trades a lot, you run into an indicator called RSI. This is different. This is not RSI. Okay, I said there were tons of technical indicators. Relative strength here has a very similar name to another one that's actually pretty popular. So note that this is different from that popular one that's called RSI. So this one we call relative strength. Recent performance of a given stock or industry compared to that of a broad market index. So what is the idea? It's how strong the stock is in terms of it moving up or down relative to an index. Okay, is it beating the index? Is it losing to the index? That's the idea. And what do they, to calculate this, what do they track? They track the ratio of the stock price to that of a market index. If that ratio is increasing over time, I'll give you an example in a second, but if it's increasing over time, then the stock is outperforming the market. For example, maybe the market is going up, the market's up 10%, but your stock is up 20%, then your stock has a lot of relative strength. You are going up more than the market. If it's decreasing, like maybe the market is up 10%, but your stock is only up 2%, then you actually have weak relative strength. You are going up less than what the market is doing, okay? So it's just seeing how strong you are relative to what the market is doing. Let me give an example here with numbers. Stock ABC had a price of $30. That was 6 months ago. And it now has a price of $34. So it's gone up from 30 to 34. What did the market do over that time? The market went from 2,400 to 2,480 over the same time period. So to calculate relative strength, what do? They look at the ratio of that stock to the market index. So 6 months ago, what did we have? 30 was the stock and 2,400 was the market. That's 30 divided by 2,400. There's my ratio. Now what is it? $34 to 2,480. 34 to 2,480. That's this ratio. And if you look, this has gone up. So this is actually an increase of about 9%. Okay? So that would mean the relative strength of this stock looks pretty good. Okay? And where I've seen this used, I'll show you where this pops up. I've seen this used to basically track which stocks are, sort of the strongest, which are trending the strongest. I like to think of this one as helpful because we saw what is the big anomaly in the so-called weak form of the efficient market hypothesis. Remember, an anomaly is something that appears to violate the efficient market hypothesis. The big anomaly in the weak form was the momentum effect. What does the momentum effect say? It basically says winners tend to keep on winning, losers tend to keep on losing. That's another way of saying stocks trend, right? Winners keep on going up, losers keep on going down. That basically just means stocks are trending, right? So here's a way, using relative strength, to sort of figure out which ones are trending the most strongly. And according to the momentum anomaly, maybe those are good ones to buy into, right? So that's sort of the way I see relative strength being used. This one I think was popularized by Investors Business Daily, which was a very sort of trading heavy newspaper. I believe they were bought out by the Wall Street Journal, but I'll show you where you can find that. So let's jump over to that. And I'm on the site of, I believe it's investors.com, but it's Investors Business Daily, and I went to stock list, and they have relative strength. That's what we're talking about here. And they want looking at stocks that have a new high in their relative strength. That is, these are the ones that are most outperforming the market. And they actually list those, okay? And they've got a relative strength rating. And I believe what they do is they actually rank the whole market based on their relative strength. And 99 here means this is like 99% of the market. They're like the top relative strength. Or it's some measure like that, but it's a sense of how strong they are relative to the market. Okay? And so this actually feeds into their trading methodology, and it's nice. They calculate it for you so you can immediately go get a list here and find what are the stocks that are sort of outperforming the market by the most in terms of relative strength. And again, those are the ones that are probably trending very strongly. Okay, and again, we look down here. Since this is greater than 1, the stock has good relative strength. And again, like Investors Business Daily, they will actually rank all the stocks on their relative strength. So you can see which are actually the strongest in the whole market. Okay, that was a quick look at trends and corrections. Those are the technical indicators that I will want you to know. In that category, in the next video, we're actually going to look at a different set of technical indicators called sentiment indicators.